Gary Abrahams,
Here.
Tim Hodges,
Here.
Kathy McKinnon,
Here.
George Perez, Franklin Perry,
Here.
Sarah Sanders, and I know I saw Sarah, so, and Gwendolyn Thames.
Present.
Okay,
So we'll start the meeting, and it's 4 reports today, and there's one action item on the minutes. So the first item is over to Hazim to report on the bond sale that closed.
Yeah, thank you. So good morning. Here with me this morning to discuss about the sale that we just closed yesterday, the 2021A for single family is Mike Castle and Susan John from Citi. Suffice to say, we saw significant interest from investors for our bonds. So much so we've never seen that type of a response. And we felt, at least based on the discussion we had with our financial advisor, along with the book runner, we thought we could have sold essentially anything on that particular day because all the bonds were in fact allotted. So there weren't any bonds left over. With that, I will hand it off to Michael for his opening remarks, and then Susan is going to explain and take you through the book.
Thank you, Hazim. And on behalf of Citi and Affordable Housing Finance at Citi, I'd like to thank the authority for the opportunity to senior manage this transaction. As Hazim stole a little bit of our thunder, I'm going to steal some of Susan's, though she'll go through the book in considerably more detail. It was, I think, by any measure, an unmitigated success. It's captured in part by what Hazim just said about the book of orders. We saw $1.3 billion in orders, and we in housing have never seen anything like that in terms of just the raw number of orders that came in on a $263 million bond sale. That resulted in price adjustments all the way down, up and down the structure of 5 to 10 basis points. And in the end, it resulted in absolute yields that I believe are historical lows, frankly, in the industry, benefited to some degree, as Susan will point out, by the structure. But the tax-exempt cost of funds was 1.3%, which resulted in over $30 million in zeros, which can be applied for future financing and program flexibility for the authority. And then just on the basis of spreads and relative pricing, housing spreads, I think, are as attractive as they've ever been. We've got some information there, but I think they're the best spreads that Connecticut has achieved in recent history. And it's all against the backdrop of the municipal indices being at historical lows. So from a market timing perspective and an execution perspective, again, I think it was just an unqualified success. And with that, I'll turn it over to Susan Jen to go through the book. Thank you very much.
Great, thanks, Mike. So we will point out a couple of key highlights, starting on this page that's in front of you, which is page 4, financing objectives and program results. So first of all, the objectives of this bond issue included 1, raising proceeds to fund new single-family loans. 2, taking advantage of conducive market conditions to current refund higher coupon debt. And 3, preserving future lending authority for use next year. So we had 4 sub-series of bonds. A1 was the refunding and new money component, the series A2 and A3, refundings. A4 was the warehousing of the future lending authority. One thing that we wanted to point out about this bond financing is that the structure was shorter and more front-loaded than typical CHFA bond financings that we've been used to seeing in the last few years. And primarily that was due to the fact that we have a very large refunding component in this transaction. I think it's roughly 75% of the tax-exempt portion, which is refunding. And so 2038 is the longest maturity in this financing. And so as Mike mentioned, the overall cost of funds on the tax exempt portion was right around 130, On the taxable warehousing portion, because it was such a short maturity, the bond coupon is 30 basis points. Okay, if we move on to page 6, which is the market backdrop. There we go. Thank you. So heading into pricing, we had very favorable market conditions from an issuer's vantage point. We had historically low interest rates, extremely strong investor demand versus low new issue supply, and that led to tighter credit spreads and historically low tax-exempt to taxable ratios. In addition, the Fed, after their January meeting, stated that they would maintain the current policy and that they do not believe higher inflation is a near-term risk. Next page, please. Okay, so towards the bottom of this page, we'd like to point out the near historic low MMD yields just before pricing. So the 10-year MMD tax exempt rate was at 73 basis points, while the 10-year treasury was at a 119. So that was right before pricing. And as a comparison today, fast forward basically 2 weeks or so, and the 10-year tax exempt rate is 36 basis points higher, and the 10-year treasury is more than 20 basis points higher. So we've moved quite a bit over the last couple of weeks. And so the authority timed their transaction very well in this instance. If we move to page 8, let's see. One thing we wanted to point out here is the graph. This actually shows ratios, tax exempt to taxable ratios. And here we see the 30-year ratio point. And you can see that over a longer history, it's been closer to 100%. And obviously we see the spikes last year with the market dislocation. But the last couple of months, what we have seen is this ratio trending down to a very low point, to historical low points. And so right before pricing, that tax exempt to taxable ratio was 70%. And today that ratio has moved up a little bit, closer to 77, 78%. Okay, so pricing and sales results, starting on page 9. So on Monday, February 8th, we conducted a pre-marketing with a preliminary scale. And during that pre-marketing period, the authority received almost 4 million in pre-orders from small individual investors through the city retail partnership with Fidelity. And so that was a great way to go into the retail order period on Tuesday, the 9th. We gave retail investors a full day to submit their orders, and this resulted in more than 158 million of retail orders that were received. And that included 83 million of orders placed by Connecticut individual and professional retail orders. On the next day, Wednesday, we opened it up to institutional investors, and the reception was phenomenal, as both Hazim and Mike indicated. For the tax exempt portion, the authority received 684 million of institutional orders. And so that is for 193 million of bonds offered. If you include the total retail interest on the tax exempt side, that component was nearly 3.8 times oversubscribed. And on the taxable side, we ended up with 8 times oversubscription of that $70 million piece. And so the authority received 93 million of retail interest on the taxable portion, as well as 473 million of institutional orders. And in aggregate, as it was mentioned, the authority attracted nearly 1.3 billion of orders across the entire transaction. And we were able to reduce yields on a majority of the maturities by 5 to 10 basis points. I wanted to point out 2 more pages here that might be of interest to you. If we could go to page 18, we have a couple of pie graphs. And so here you can see visually, the top pie graph shows the orders that the authority received from both retail and various institutional investors. And you'll note here that we also have a couple of bank CRA orders placed by both Citi and Morgan Stanley. The bottom graph shows the distribution of how bonds were allotted at the end of the day. So obviously the difficult part of the transaction here for our underwriter was the bond allocation process, given the incredible amount of interest that we received. And then the next page, page 19, is a visual of the Connecticut retail orders that were received and also the allotments. And so you can see here, there were 5 counties where the orders came in. And total allotments to Connecticut retail was more than $6 million. So that's a highlight of this transaction. We're happy to take any questions that you might have. And if not,
I have one question,
Sure.
Susan. So so and maybe this is a question for Hazim, but the taxable piece that's that's just going to be warehoused, correct? On the new money?
That's exactly right. So there were replacement refundings that the authority doesn't have a need for immediately. And so they are able to warehouse it in the short taxable bond. And in 2022, the authority can refund that portion and roll it out into tax exempt long-term bonds for
Which they have a purpose, right?
Exactly.
And so right. So and then there's no, I mean, just given the structure rates assume that there is no or negligible negative arbitrage on that?
There will be some negative arbitrage from the standpoint of we are reinvesting the proceeds, the 70 million in the Treasurer's short-term investment fund. So
right, because it goes in her it goes in Sarah's, I guess, fund. And what is, I mean, is I assume it's pretty negligible. I mean, so short, right? And rates are so compressed.
Can't be too big with 30 basis points of cost, Jerry.
Yeah, right. Okay, I figured.
Maximum would be 30.
Right, and it's not. It's probably 20 though.
It probably is.
Yeah.
I just want to note that, oh, I'm sorry, Jerry, finish up.
No, I'm done.
I just wanted to note that the state's last bond sale, 800 million in January, we got the lowest interest cost on record, 1.8% on a 20-year bond issue level principal. And the pricing spreads to MMD were the lowest we've seen in 6 years. So it's a great time. And we think, a lot of it's the market, but some of it also, we hope for Connecticut is we have a really strong rainy day fund, and it's a real credit positive that we haven't had in the past. So investors are noting that. I don't know if that helps out CHFA at any point, but it's a great time to raise capital.
Sarah, we would only add that that's entirely true. The market is off a little bit in the last few weeks. It's backed up. The treasuries are up. And for the first time this year, municipals have followed suit. They're following treasuries up, and they're underperforming them in the current market. So really, from a market standpoint, the issuer of tax exempt debt in particular, Connecticut could not have timed it better. Deals that have come to market, we've been involved in some in the last week, have struggled a bit more than Connecticut did, though rates are still at absolute lows, to be sure, or near absolute lows.
And Mike, could I also add that in addition to obviously the conducive market conditions, the success of the sale is also a testament to the authority's highest bond ratings, the premier name recognition in the marketplace, the proven success of the authority's affordable lending programs, and obviously the very strong debt management and program disclosure that you provide in the documents.
How do you decide who to sell the bonds to? So if you've got 5 times as many orders, is it just price driven, or is there an attempt to do multiple industries? How does that work?
So the way we approach this is we initially gave retail investors an opportunity to come in before the larger institutional investors. And so the first day that we were out with the order period, we left the whole day open for retail investors to come in with their orders. And what the authority specifies is that the first priority would go to retail Connecticut retail investors, and then national retail investors. So that's the order of priority for the retail orders. And then once that is done, we open it up to the large institutional investors. And because we had so much demand, what we did in this case is that even though many of the bond maturities were fully subscribed for by the retail investors during the retail order period, the authority decided to keep it open to all investors and say that the authority is using what we call the 50% rule, which means that even if you're oversubscribed in any maturity, it's up to the authority's discretion, if they want to limit the bond allotments for each maturity, half to retail investors and half to institutional investors, so that it's a little bit more balanced in that way. And then at the end of the day, with the entire order book, our underwriter will keep those rules in mind when he formulates a bond allotment for the entire transaction. And then that proposed allotment schedule is shared with both Hazim and Bob Lamb, and they review. And we get their sign off. So that's sort of the process of going through the allotments.
Can you guys given what you're seeing in other HFAs across the country, given the sort of size of your practice, can you just give us some perspective on our experience? I know that the muni market has been on fire up until, I guess, just a few weeks ago, or in the last few days. But your perspective on just how we're doing on a relative basis, how much of this is just, okay, which is fine, just really good timing on the part of yourselves and Hazim on capturing the market at the exact best point. But how much of this is sort of people looking at Connecticut, or specifically at the Connecticut HFA, on the sort of the relative factors, and saying, in a market on fire where there's, where I have to buy bonds, where interest rates, this is still this attractive asset class. How much of that is kind of, unique to the Connecticut HFA story, and what aspects of the Connecticut HFA story are most resonating with buyers?
I'll start, Susan, and let you take over. I said this a few years ago, nobody prices better than Connecticut. You can find exceptions to that rule, but Connecticut prices because of its AAA rating, because it comes to market regularly, and as Susan has pointed out, is a very familiar credit, very, very strong disclosure, and because Connecticut is a high tax state, a high net worth state, and has a lot of buying power. It prices at the very best levels for state HFAs across the country. There may be a few peers, but not many. Maryland used to be, California was at one time, and maybe a couple of others, but California prices as well as anybody. There, again, we can find exceptions to that. But Susan, do you have any more details to add on that?
Maybe one thing that I would add here is that it is true that there was so much cash coming into the market and relatively low new issue supply. And so, it was a seller's market from an issuer standpoint. But, maybe one other factor here is that, again, because CHFA is well recognized in the marketplace, the authority comes to market on a regular basis with good sized transactions. And so for investors, they realize that, they're able to get a little bit more yield because this is a housing bond, but also knowing the fact that this is a AAA rated credit, that you would have a little bit more liquidity because this is a major issuer, who comes to market on a very regular basis.
Thank you.
Questions? Okay, well, thank you and excellent job on that bond sale. Our next
Thank you.
item-
Thank you very much.
item is financial reports from Allison Murphy.
Good morning. Before you are the financial reports for the first month of 2021. On the revenue side, mortgage loan and investment interest revenue are coming in slightly below budget for the month and 1.2 million lower than prior year. The year-over-year variance is being mainly driven by a reduction in our program assets, mainly our mortgage-backed securities. This is a result of higher rates of mortgage prepayments, lower single-family loan production in conjunction with MBSs being purchased at lower yields. On the expense side, bond interest expense is below budget by 1.1 million and 1.4 million lower than prior year. With slower than normal reservations, the authority has issued more refunding bonds than long bonds, which is lowering our interest rates and our interest costs. Administrative expenses are coming in 706,000 under budget and 68,000 less than prior year. When you exclude salaries and benefits of 2.1 million, the current year-to-date expenses are 12,000 higher than last year. Bond issuance costs is essentially a timing issue. Our first bond sale obviously is in February, so that expense will start catching up with us next month. And lastly, the change in net position is above target by 104,000. Are there any questions?
If there's no questions, we'll go to the next report, Delinquency and Forbearance, John Chilson.
Good morning. For the month of January, the authority purchased 107 loans totaling $20.5 million, of which 95 of those loans totaling $16.6 million were securitized for 89% of our production. Remaining 12 loans totaling $2.9 million for whole loans. The average loan size was $192,000. The January month-end mortgage-backed security balance was $2.32 billion, a decline of $17 million from the prior month, while our whole loan portfolio in December declined 164 loans, or $22 million, ending with a portfolio balance of just under $1.5 billion. Our single-family delinquency rate declined month over month by 59 basis points to 3.06%. And the carrying balance for loans and foreclosures decreased by $2.8 million to $39 million year over year, while the number of loans in foreclosures declined by 21. The authority also funded 43 down payment assistance loans in January, totaling $358,000 with an average loan balance of $8,300. 40% of our January borrowers took advantage of the down payment assistance program. There were 644 loans in forbearance in December, involving $450,000 in monthly payments on a loan balance of $79 million. There was just about 5% of our whole loan portfolio. Of those, though, of the loans in forbearance, though, 19% of them made a mortgage payment in December, despite being in forbearance. In January, that number declined by an additional 26 to 618 loans in forbearance. We had no new multifamily loans close in January, so our total loan count did decline by 4 loans to 546 on a UPB of $1.25 billion. There were 10 permanent loan delinquencies and 1 construction loan delinquency for an overall delinquency rate of 2.7%. And then we had we currently have 2 multifamily loans in forbearance. They're small loans. The monthly P&I payment is $6,800 on a loan balance of $587,000. Any questions?
There's
I know
no
we-
question. Oh, go ahead.
I'm sorry, Sandra. I know we talked about this last time, but again, I mean, I know the results are really good, but our production is just down so much. And I know that's partly for factors outside of our control, but, if we could just, address that, just the fact that, our volume is way down. I just feel that, are we running the risk of, underserving the community?
Yeah, Jerry, I invited Valencia to this meeting. So Valencia heads our single family program, and she has been doing some research about what we encountered in 2020, the result from that 2020, and she also reached out to the regional states, or the New England state, I should say. So Valencia, can you provide and give some color?
Sure. Good morning, and thank you for inviting me and giving me the opportunity to share with you. We were looking at our production and wanted to just address the fact that our production has had a significant decline in our reservations and in the purchases since 2019. There's actually been about a 54% decrease in the number of total loan reservations and about a 56% decrease in the total number of loans purchases. This was an abrupt turn in business for us, but it's a result of multiple challenges that are facing the first-time home buyers in our state, as well as throughout the country. That includes the decrease in the inventory of available homes for purchase, spiraling increase in property market values, bidding wars among the first-time home buyers who lack the resources to compete, an influx of the number of out-of-state buyers that are coming in with cash in hand and competing for the same properties, and of course, COVID-19, to name a few. So these influences, as you know, are not unique to Connecticut. So we conducted a very informal survey of several of the New England housing finance authorities to try to learn about the impact on their areas as well. We received responses from Maine, New Hampshire, New Jersey, Rhode Island, and Vermont. And what I found out was Maine Housing confirmed that they're facing the exact same challenges as Connecticut. They track it to the beginning of the onset of COVID, which is about exactly a year ago. They said that although they had a 13.78 increase in the number of home sales in the state of Vermont, their production decreased by approximately 10%. And they're continuing to experience the decline in loan reservations through January and into mid-February. New Hampshire Housing had a slightly different story. They confirmed that they're facing the exact same challenges as we are in Connecticut, but they have not seen a decrease in their volume. They had an initial downturn with the onset of COVID. It started out very weak, but then their reservations rebounded and they remain strong. One thing to note about New Hampshire is that they also finance their mortgage loans with other pools of money, including mortgage credit certificates. And they also offer refinancing. So they've been able to take advantage of the refinancing boom that is prevalent in the industry right now. New Jersey Housing said that they are experiencing the exact same conditions as Connecticut. Their volume is pretty strong in terms of referrals. The way that their program operates, they get a referral from the lenders, and then the referral then sometimes turns into reservations. So the number of referrals for them doubled in 2021 from 300 to 600 a week, but it hasn't yielded them any commensurate increase in reservations. So although people are talking up their program, they're not actually reserving loans. They note that the stagnant AMI levels make it difficult for borrowers to qualify because of the increase in the sales price and then the subsequent increase in the loan amounts that their borrowers are not able to afford. Rhode Island Housing said that although their volume throughout the state grew about 3% year over year, the number of mortgages that they produced decreased by 7.5%. The increase in the sales had to do with the higher loan amounts, not the increase in volume. They didn't specifically address all of the other issues, but it's safe to say that they are actually impacted by the same constraints as we're finding in Connecticut. And Vermont Housing said that they also have the same challenges. Their production went from $80 million down to $51 million. They also noted that there was an industry change in the type of conventional financing that we can allow for the MBSs. The loans are restricted to applicants at 80% of the AMI, and that had an impact on their production. So I wasn't able to talk to Mass Housing or any of the others, but this is a good critique of what's going on in the industry. We did notice a slight increase in the number of reservations over January. They went up about 4%. We believe that the changes that we've made to our down payment assistance program is going to have a significant positive effect on reservations going forward. And we're continuing to monitor the activity closely. And that's it.
Sounds like our first-time home buyers are really getting squeezed in this hot market. You know, they're getting probably shut out with people with cash offers, and that's a concern.
Absolutely. But I do believe that the down payment assistance that we're now providing is going to help to bridge that gap. And the fact that we we've eliminated the asset test restriction will bring more applicants into the first-time homebuyer market using CHFA loans.
Hey, Valencia, it's Tim Hodges. If I heard you correctly, you said our volume has been reduced by roughly 50%. It sounded like, is that accurate? But it
That's
sounded
accurate
like,
year over year. Mm-hmm.
yeah. But it sounded like in some other states it hasn't been as bad. Is that accurate, or is it? Because I heard 10% at least on one of those, but how about
That
the
is
others?
accurate. In other states, it hasn't been quite as dramatic, but it is occurring.
Okay. I also mentioned, and I feel like it was the last meeting, we talked about refinancing as a potential option. And I know that there was pushback on that, at least from a couple people. But is that something that staff has been talking about at all, or is that not even been put on the table?
It's been put on the table. I'll let Hazim discuss that. No, it's definitely on the table, Tim. What we're trying to do is we're trying to come up with ways and the mechanism to provide the takeout for the refinancing. So we are looking at this at multiple fronts. We have been talking with the COGS about trying to work with them and engage them in terms of how to best serve, first-time homebuyers in their communities. Valencia and her team have been trying to devise a rehab program that would help certain communities that requires funding to like what do you call that, buttress, the devaluation of their homes. We are also trying to work with the Habitat of Humanity in pursuing more homeownership program, things that they are doing. And then the refi is also one of the things that we're looking at. So we hope to have something for the board within the next few months. It's just that we're trying to address all these needs and then trying to align them so that we don't trip on ourselves.
I hear all
enough.
the,
I appreciate that outlook. The only thing, and look, I know you guys are slammed with stuff, but the next few months sounds like a long time, and will we be, in a completely different place in 3 months from now? I don't know the answer, but just something to think about. If my question, I guess my point is, if there's low hanging fruit right now, why wouldn't we go after it, as opposed to trying to have a package?
Agreed. I mean, I think so we're in February. The homeownership money is coming, which
Yep.
is in the month of May. We've already have something in mind in terms of trying to increase brand awareness. But then, and again, we want to do it in a manner where it's sustainable, and then it makes sense, and we will present it to the board and make sure that you agree with the way that we are approaching it.
Thank you.
And okay.
I hear all the time that it's a question of stock. And it looks like the average loan, are for houses less than 200,000. So has that stock been dwindling because those $200,000 houses now the prices are ratcheting up, or is there a way to track what the stock is? Because I think the part of the problem is that people on the lower end of the income spectrum, their incomes don't increase as quickly as probably housing prices do, so they can't keep up with what the increasing prices are.
Yeah, so why don't we transition to Sherry, because Sherry has her report, and then on top of that, Sherry did conduct some research for us, looking at the Warren Group data, essentially addressing, Kathy, the point that you're making. So Sherry, do you want to go through your report and then respond to Kathy?
Sure. So I'll just quickly go through the multifamily development that you'll see today at the board. This is a $9.3 million tax-exempt bond deal. It's a preservation of elderly housing in Bridgeport. It's 83 units, which are all studios and 1 bedrooms. And it's also very close to all the transportation in Bridgeport. So this is a really important acquisition and rehab that we're doing. And you'll hear more about that at board. So in the home ownership area, as we talked about there, we're about 50% off for first mortgages. At the same time, we're seeing an increase in first mortgage prepayments as well as DAP prepayments. So the market is sort of changing. And what we saw when I looked at all the sales in Connecticut from the Warren Group is that one of the biggest findings was that there, in the last year, when you compare 2020 to 2019, there were a lot of cash sales in both our market as well as the whole market. Because what we do is we split out our market, and then we also look at the entire market of Connecticut, which includes our market, but it's just 2 different views. So in both markets, there was considerable down payment money put, more so in the higher end market. So for that says to me that that's not first time home buyers, because they generally don't do a lot of cash sales if you're a first time home buyer. So that sort of indicates that our first time home buyers are being pushed out by people who are trading up or trading down. So there's, as Connecticut is aging, there could be people going into what would be a first-time home that want to downsize. So that's one competition. There are people moving from other states who have sold a home and just want to buy something outright. People who are retiring want to buy something outright and not have a mortgage. So it used to be the first-time home buyer home was pretty much for first-time home buyers, but we're seeing more people going into those homes, possibly from other states. They want a smaller home as a second home, and they buy it with cash. So there's a lot more competition for the first-time home buyer now. So I think what Valencia and Hazim have been talking about will probably make some difference in the market. In addition to other things we can do, there's a lot of triggers we can pull in the next few months. But you probably won't see some of the results of that because what you're looking at now are really purchases from November, because we do have an almost 2-month lag. You won't see that until, some of the results of that till probably summer. So you can expect every month to sort of see this kind of thing. And then hopefully March, April, May, we'll start to see some increase based on some of the triggers that the single family group is going to pull. So don't be surprised if next month you see the same thing because you're looking at December's purchases. But I think things are bright. I think there's a lot of competition out there, but I think there's a lot of things, and we've talked in the strategic plan about the things we're going to do to help new homeowners. And to Jerry's point, we hope to be focusing on areas of need so that we don't miss some people who are really in need. So our market may change a little as far as demographics because we really are going to focus on people who really need our program. And we really aren't in competition with the other lenders. We're in competition for ourselves. We have a different market and we need to sort of carve out that market for ourselves. So I don't know if you have any other concerns or want to know anything else about the market as a whole, but I'll open it up for questions.
This is George. I want to make a statement and
Okay.
go from there. Look, anything we can do to help people become homeowners, I'm for it, right? Otherwise, I wouldn't be in this board, right? And I wouldn't have 30 years of past experience in organizations like Habitat for Humanity, Hill Development, and so forth. Now, having said that, what I'm seeing as a Commissioner of Banking, and what I'm hearing is, yes, there's things that we may be able to do that will help, but we're in very special circumstances right now. And the one thing we need to, that I really would like us to keep in mind is that in the next 3 months or so, I would think things would get better, except for 2 groups. Actually, probably 3 groups, right? The renters, which that's going to come due, right? And there's a lot of aid probably coming from Washington if the package passes, but somebody's going to have to minister to that, right? And there's 2 entities that are probably going to be front runners, DOH and CHFA. And then the other group is those homeowners, those current assistant homeowners who are struggling making their mortgage payments. So EMAP and some of those programs are going to get modified, whether we realize it or not. And we're going to be asked to put a lot of more resources into helping people who are now currently behind their mortgages to catch up. And the third one is, to be honest, I'd be interested to look who's the typical person we help. And I would think that those are going to fall into the categories of people who got impacted the most by COVID-19, meaning the factory worker, the waiter, the people who make less money, and into their work life or their work future does it get settled. How many people who work in the hotel industry is going to come back? How many people in the hospitality industry is going to have a job? I don't think they're going to be thinking a lot about becoming first-time home buyers because they're trying to survive. So having said that, I'm not saying we shouldn't look at ways to try to improve our programs and ways that we should try to help people, but we could put a lot of resources and energy into something that at the end of the day may have only insignificant statistical difference. And I would like to just remind the rest of the board that what we're going to be asked to do is put a lot of energy into renters and those people who are now in risk of losing their homes. Not today, but probably 3 months, 4 months, 5 months from now when the freeze on foreclosures happen. So it may sound like I'm speaking out of both sides of my mouth, but I'm trying not to. I'm just trying to be realistic that time is something that we don't have a lot of, and there's only a limited amount of it. And considering what we're going to be asked to do, I really would like to better understand who we're trying to help or who we're going to be able to help, because even if we understand who it is, are they really going to be ready, no matter how attractive the program is, if they're not sure they're going to have a job? And please don't misunderstand my comments to say that I don't think we should be helping people become first-time home buyers, okay? That's not it.
Yeah, we actually have been looking at some of the employment, where people are employed data, and we have the same concerns as you do.
So I'm not saying we don't do nothing, because that's not what life is about, right? To me, a problem is a challenge, right? It's an opportunity to shine, right?
Right.
Whether it's housing or health pandemic. I mean, look what this country did, right? Came out with 3 different vaccinations in less than a year, right? I mean, that's unheard of, right? So problems like this are simply opportunities for us as a country, as people, to rise, right? So I'm not saying that's because we have problems we don't attempt to rise and address it, but we also got to be practical.
I thought it was interesting in your report that the January 2019 to January 20 home loans, there was a pretty significant increase in number of people purchasing in urban areas, as well as percentage of minority home buyers, which is a positive trend. Do you think that's a trend, or is that just sort of a one-off?
There was an increase, but because it's only 1 month and there was only 107 loans in 2020, I wouldn't take it as anything, because we've seen sort of the same when you look at the whole year. Like last month when we looked at the whole year, it was very similar. So it could just be just not enough of a sample to look at, but it is interesting. I know we'll be doing more targeting of those areas. So, that's the type of person we want to help. And as Commissioner Perez said, we also want to help people who, may have lost their job and don't have anything to go back to, not as far as maybe single family home ownership, but sort of exit plans, or, how do we keep them in their homes?
I really feel like our world's going to change again in the next 6 months with all this rapid rollout of the vaccines, and we're going to have a different situation, and as people get back to work in the retail and restaurant industry. So I think our world's about to change again in the next 6 months. And I agree that our customers probably are the ones that were impacted the most, in retail and restaurants and all of that. So all the people on unemployment. So as people get their jobs back, hopefully they can start to think more.
Also,
this is Glenn. I'm sorry, this is Glenn Thames. I just wanted to echo what Commissioner Perez said, but also making the point on, as we think about kind of the trajectory of unemployment, clearly there's going to be there has been and probably will continue to be some permanent job loss, but we are making a significant effort, an historic effort that we haven't necessarily done in the past as a state with workforce development. So when you think about those dislocated workers, primarily in the food and accommodation industries that have been impacted, we are making significant investments to skill them up, retool them, and get them in more sustainable career tracks, right? In advanced manufacturing, IT, or what have you. So just a parallel track relative to those workers being able to get in more sustainable, gainful employment that can put them in a position for home ownership. So I think the world is going to continue to change, over the next several months, but long term, I think there's going to be tremendous opportunity.
I totally agree with Gwendolyn. As someone who sits on the board that does job placement and that kind of stuff, I can see that. And that particular entity has benefited from some of the initiatives that DECD has put out there. In fact, DECD is one of the major funders of it. So I'm very familiar with that. But I mean, like Gwen said, it will take time because they'll have to get trained, they have a job, they have to pass the period. So all I'm saying is when whatever we come up with, and we should come up with always ways to try to improve our services and who we reach out to, it's going to take time, number one. Number two, about the urban areas, what I've been reading is that was happening, and this is one of the main reasons what people coming from New York are using, is that people who live in the cities, you know, they were comfortable when they used to go to an office to work. Now that they have to spend so much time with their family in their homes, they're finding out that their homes may not be practical in many of those larger cities. So where some other areas inventory has not become available because of people in cities wanting to move to the suburbs now, and there's been a move in that, it has made some inventory available in some of the urban areas. I don't know how much that has happened in Connecticut. So that may also explain a little bit why you see some more home ownership in the minority and in the cities area, because there are people who also live in cities to go, I mean, you know, big cities to go to smaller cities.
Yeah,
Thank you.
I would agree with that, Commissioner. There's been a lot of COVID-induced migration, particularly in Connecticut and Fairfield and Hartford counties. And so that's really where Connecticut cities become attractive for those families and individuals that are looking to get away from the more extreme dense cities to kind of more moderate, smaller size cities that we have here in Connecticut.
Any other comments? With that, we'll move to the last item, which is approval of the minutes from the January 28th meeting. And may I have a motion?
I'll move. Jerry Abrahams.
Second, Tim Hodges.
And I guess we'll do a roll call vote.
Jerry Abrahams,
Aye.
Tim Hodges,
Aye.
Kathy McKinnon,
Aye.
George Perez,
Yes.
Franklin Perry,
Yep.
Sarah Sanders,
Aye.
and Gwendolyn Thames.
Aye.
Unanimous.
Okay, now a motion to adjourn. Everyone in favor, please say aye.
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 Goodbye.
Hey, thank you.
See you in the next meeting.
Thank you.